What up, world? Is Mac. Tell me something so we can make it stick, man. Listen, I have a very, very amazing show for you guys, man. Something really special. You know, I cover a wide variety of topics on my channel. You guys know, I mean, I have conversations with people from all different type of backgrounds, different various industries and disciplines. But today, I have an individual that's extremely knowledgeable about the one thing that's relevant to us all, whether we I mean, I haven't met a person yet that doesn't want to talk about, or at least learn about, the importance of financial literacy and money. Now, everybody want to spend money, and people say they want to make money, but let's talk about the importance of how to keep money. That's extremely important. So, individual I'm bringing on today, my guy Tommy Stapleton, extremely, extremely, extremely knowledgeable. You guys will get a lot of mileage out of this conversation. Like I did myself, I've had the pleasure of talking to him off camera individually, and the brother's extremely knowledgeable. So, without further ado, I want to bring up Tommy Stapleton of Collective Wealth Partners, man. Let me get him up here for everybody. My guy, Tommy.
Mac, what's happening, man? Thanks for having me. I really appreciate the opportunity to be with you today, man.
Hey, man, it's good stuff. So, Tommy, kind of like, man, before we get into financial brass tacks and things of that nature, kind of tell us a little bit about yourself, man. Where you from, and kind of your origins, and what parts, and then kind of what was your foray into financial education and literacy, so to say.
Well, I went to high school in Brandon, Mississippi. I grew up in Chicago, Illinois, and I've kind of lived all over the place. I now live in Atlanta. I've been in Atlanta. It's my second go round actually in Atlanta. I've been here since 2016. I've been in what I like to say the money business for over 20 years. I started out owning my own mortgage company up until the mortgage crisis happened, and then got into investing in insurance. And as of recent, the last 12 years, I've been in investing and portfolio design, financial planning, and retirement planning.
Okay, all right. So originally from Mississippi, you went to Chicago. Actually, Tom, that's where I'm from, the south side of Chicago, ironically.
Yeah, exactly. Yeah, okay.
Yeah, born and raised south side of Chicago, man. And then you say, I like that you said you've been in the money business. So kind of time, what I want to do with this is let's talk about the basics. Everybody knows how to, what we've been told. Get a job, make money. That's what we've been told. Get a job, go make some money. We're never taught really, man, how to really think, invest. We're taught to work for a dollar, but not to make a dollar work for us. And I want this conversation to be, predicated around how to make a dollar work for us, vice what we've been indoctrinated with, and how to work for a dollar. So let me ask you this, Tommy. Where do you think in our community, black, brown, for the most part, where do you think we have kind of veered off to versus where we should be veered on to, so to say?
I don't really think it's a matter of veered off or on. It's a matter of mindset. We were never, you said it perfectly. We were never taught what to do with money. And, I'll be honest with you, black and brown folks, we're very talented in what you just said, going to make money. We know how to hustle and make money. Right. The challenge occurs when we get the money. What is it that we do with it? And it's a mindset thing. Do we spend it? Do we save it? Do we invest it? What is it that we do? And I'll tell you a quick little story. What kind of changed my mindset of me discovering where this different comes from. I used to be in banking, and I worked for a very large bank in Ladue, Missouri, which is a very prominent community. And this little kid comes into my office one day and he tells me, "Hey, man, I want to open up a bank account." I look at this kid. I'm like, "Man, get out of here. I don't have time to be playing around with you. This is a place of business." And I happen to look up in the lobby and I see this guy. He's like, play along. And the kid, I said, "Okay, man, have a seat. How old are you?" I asked. And he said, "I'm 14 years old. I said, "Do you have any money to open up an account?" He said, "Yeah." He pulled out a Ziploc bag full of cash and plops it on my desk. And I'm like, "Whoa. Wait a minute. Like, where'd you get this money from?" He said, "My bar mitzvah was last weekend." I said, "Okay." I said, "How much money do you have?" He goes, "I have $734 in this bag." And I'm thinking, okay, after you open up this account, I asked, "What are you going to do with this money? You're going to buy some things? You're going to buy some candy, a bike, toy? What are you going to do as a 14-year-old kid do with $700. And he said he made a statement that really changed my life forever, Mac. He said, I can do whatever I want with this money, but I had to make a deal with my father. Now I'm intrigued. I said, what kind of deal did you make? He said, my father told me for every dollar I spend, I have to replace it with 2 before I can spend the next dollar. Let me let that sink in for a minute. Before every dollar I spend, I have to replace it with 2 before I'm allowed to spend the next dollar. So in essence, the father taught his kid how to save money, how to budget money, and how compound interest works in its most simplest forms. I'll ask you, Mac, if you had that philosophy at 14, where would you be right now?
Man,
exactly.
me being, that
Exactly.
I couldn't even.
You can't even imagine, right? So that's where the challenge comes. It's not, are we on the right track? Are we off the right track? We've never been in the car. We weren't allowed to get in the car. You see what I mean? Because that knowledge was kept from us. Because I think about that. If I had that information the way I hustle at 14, I mean, who knows? But now you know that kid, and that was about 9 years ago, you know that kid right now is a millionaire somewhere. And so the father comes in and I asked him, I said, where did this philosophy come from? He said, it's been in our family for generations. I was taught this at my bar mitzvah. The girls are taught this at their bar mitzvah. It's just our Jewish way of sharing generational wealth. Learn how to save at 14. Now, at 14, did you know how to save money?
Not to that magnitude.
No, not at all. Not with that, not even that magnitude, not even with that discipline. That's a discipline. That's not a magnitude. That's a discipline. And you know, if he's got kids, he's teaching his kids that, right? And it's generational. So we have a mindset problem or mindset challenge, if you will, when it comes to money. Again, we don't have a problem making it. We're all about the hustle. We're all about providing for our family. We're all about making that next dollar. But how do we make it grow and save to where we're creating generational wealth instead of generational debt? That's the question.
I get that. And my question is, Tom, we said that 80% of the people, 80% of Americans live in, paycheck to paycheck for the most part.
Yep.
I mean, for me, it's a simple solution. Obviously, you most likely live in above your means. But how do you tell a person, Tommy, that's been living like that the majority of their whole life? How do you say, hey, you know what? We got to fix this. Where do they start at? If they've been living paycheck to paycheck, what's the first thing you recommend a person do?
The easiest way to eat an elephant is one bite at a time, my friend. So how do we save money? Let's start with an emergency fund. Since 80% of us are living paycheck to paycheck. So if that paycheck is gone, how do we sustain our lifestyle? So let's address that issue. 80% living paycheck to paycheck. So let's take our expenses. Let's say our expenses for the month is $4,000. If you had 6 months of that in an interest-bearing account or in a liquid account, savings account or a money market savings account, that's accessible. You need $24,000 to be in the right mindset of not living paycheck to paycheck. Because when you're not living paycheck to paycheck and you have an emergency fund, you go to work with a different attitude. I'm going to give you all I got because I'm not scared of losing my job. I'm going to give you all I got because you're getting me, not the scarce mentality of I got to be here to make sure that my light bill gets paid. Right? $24,000. It's a lot of money for a lot of people. So let's break it down. Let's take it by segment. Your car payment's $400. Can we save 3 months of our car payment? Can we stop going to Starbucks 3 times a week to save $1,200? Can we stop buying things that we don't need to impress people that we don't care about with money we don't have to put $1,200 in a savings account? It's about discipline. Because here's what I can tell you. As a financial professional, most of us, we buy what we want. But in our community, we'll beg for what we need. That's the break we have to make.
I agree. We buy what we want, And beg for,
And
because
beg
people
for
can
what?
afford what's people can afford what's important.
If it's important to you, you're going to find a way to pay for it. I don't care who you are and what you are. You are going to find a way to pay for it.
Hey, that's a fact.
Now,
I
if I
had a
want to
drunk uncle.
create, go ahead.
Go ahead. No, I said I had a drunk uncle, Uncle Buck. He stayed drunk and broke at the same time. You ask him for $1, he can never give it to you. But at the same time, he kept something to drink. And you said, well, Uncle Buck, how the hell are you getting this money? Because getting that drink was important to him.
Exactly
saving that
right.
dollar. So yeah, absolutely.
But when you're talking about
totally.
leaving generational wealth to your children and having a life insurance policy, oh, that's an expense. I don't know, man. I got to think about it. I don't know if I don't know if we can afford that. I don't know.
Let's talk about life insurance. That's
Sure.
that's something that for some reason none of us I don't know. Sometimes folks of color forget none of us get out of here alive. None of us gonna get out of here alive. We all got to get out of here. We got to check out one day, people. I know it ain't a fun conversation, but it's a real one. Generations, other cultures have built wealth, Tommy, through life insurance and things of that nature. And actually, you educated me on something. We opined about it off camera privately. That I think a lot of people don't know how life insurance can be a tool, not just something that's somber and sad. Well, damn, I'm just getting this. No, you can get a policy that'll benefit you while you living, but you got to know which ones. And I'm gonna let Tommy give an overview of it, and let's talk about that, Tommy.
Well, first of all, we have to understand what life insurance is. Most of us feel like life insurance is to try to leave a legacy, and most of us will say, "Well, I just want a life insurance to cover my burial. Yep. I just have enough to bury me, right?" Yep. But if you dig a little deeper, there's two types of life insurance policies. There is a term life insurance that is just that. We call it in our business renting insurance. It's like renting an apartment. You don't own any equity in it. It's not building any value. You're renting it insurance for a particular time period, 10 years, 15 years, 20 years, 25, 30 years, whatever that number is. Once the policy has reached that term, you have to die within that time span for someone to benefit from that. Now, I'll give you a little disclaimer. There are useful benefits to term insurance. If you own a business, for example, and you have a partner and you want to make sure that his half of the business is held, you might want to get a term policy on him or her, right? But if we're talking about a personal matter, term insurance serves a purpose. You are insured for your loved ones for a certain period of time. Now then versus permanent insurance. Now you buy the insurance. You're not renting it, you're buying it. It lasts until age 121. It has three main components. One, the premium is flexible. Two, there is a cash value or investment account inside of that policy. Three, it also has a death benefit to leave to your beneficiaries. But the most important part of those three is number two, which is a cash value account that you can use that money while you're living. Here's the best part of it. It meets one of the tax buckets that I often talk about with my clients. There's three tax buckets that we need to refer to: taxable, tax-free, tax-deferred. The cash value in a life insurance policy is tax-free. You can withdraw that money. You can put it in other vehicles. You can send your kids to college. With most people that don't look like us, that's how they send their kids to college, through cash value life insurance, because it is a tax-free transfer of money. So the living benefits is where we get lost. We get that term policy. Oh my God, it's so great. It's $50 a month. But what is that $50 a month doing for you? Over the course of 30 years, you spend $50 a month. You spend a lot of money. And at the end of that, you got nothing to show for it. No. Spend a little bit of more money, depending on what stage of life you're in. You build a cash value account. Now you can borrow against that. You can withdraw that tax-free and use it to fund other things. That's the beauty of life insurance. It's more than just, I'm leaving something for my kids. No, I have a tax-free vehicle inside of my portfolio to use how I want to use while I'm living today. That's what life insurance is.
Man, that was a great breakdown of that. Let's talk about that. So with this tax-free vehicle, are you at liberty to, like with a regular term policy, whatever that term is, that's what you pay. So whatever that monthly term comes to, that's what you pay. But with a life policy, a whole life policy, are you at liberty to pay even more into
Absolutely
that?
you are. Absolutely you are. Let me tell you the secret. The secret is, so if we know the Rockefellers or the Vanderbilts or families of wealth that have built generational wealth, like they have money that kids that aren't even born yet will never spend. Right? Every time a child was born, a variable universal life policy was created for that child. And the family trust was the beneficiary. So they would overpay those policies so that the cash value would grow and they would withdraw that money tax-free. Now, the question that you asked, can you overpay that? There is a limit to every policy. The IRS says, because those families back in the day were doing that, they were saying, hey, you can't really do that because you're avoiding some tax liability. You know, the government's always got to get their piece of the pie, right? So they will limit you on how much you can put into a life policy. So if your premium is $100 a month, $1,200 a year, you might be able to put up to, let's say, $3,500. It depends on the policy, it depends on the design and how we structure it, what that number is. But for this example, let's say it's $300 a month, $3,600 a year. Now, where we get into trouble is that you cannot go over that amount by $1. Okay. If you go over that amount by even $1, the entire policy becomes taxable. The death benefit is taxable. The cash value is now taxable. You've turned it in what we call a modified endowment contract, because now it's a tax vehicle. It's not a tax-free vehicle any longer. So, but as long as you play the game, yes, you can overfund a permanent life insurance policy. Yes.
Okay, Tommy. So when we're talking about individuals that have a basic portfolio, they say, hey, you know what, Tommy, I got a savings account, I got a checking account. Oh, but Tommy, I got a 401k at work. I'm good. I'm good, man. I'm good. So, Tommy, why do I need you when I got a 401k at work? I'm putting money aside, man. If they're investing for the stock market, I'm matching dollar for dollar. I got a 6%. Like, I'm good, right?
Well, that depends. Do you know what you're invested in? Well, let me answer that question this way. Yeah, you are good. But do you know what you're invested in? Do you know what a stock and a bond is? You got a 401k. Do you know what's in it? Let me give you a scenario. You're 64 years old. You want to retire at 65. You've got $200,000 in your 401k that you're banking on, not even thinking that you've got to pay deferred tax on that. But it's COVID. The market went down 40% and you're about to retire. Are you good?
Hell no, you ain't good.
You ain't good.
No, you definitely ain't good.
You're not good. Right? That happened to a lot of people. Right? Now I can't retire the way I wanted to. That's why you need someone like me to make sure that all three buckets of money are being impacted. 401k, that's just one bucket. That's a tax deferred bucket. How's your taxable bucket? Do you have a brokerage account? Are you in a high yield savings account, money market savings account? Tax-free bucket. Do you have a Roth 401k or a Roth IRA to counterbalance that traditional IRA or traditional 401k? Your administrator, your job is not going to tell you that. That's not his job to do that. They
okay, Tommy, the guy
tell you what you invested in.
Great answer. So the guy says, okay, Tommy, all right, you got me. But I got an insurance policy with my job. I'm good.
Okay.
Okay.
You are good for as
awesome.
long as you work there. You're as good as as long as you work there. Because when you quit, it's not, life insurance is not like health insurance. There is no COBRA for life insurance. Right? You can't take it. You can't take it with you. They might give you 30 days to transition it to a private policy to where you're paying that insurance company directly. Most companies don't even give you that option. Some will say, okay, we'll give you a 30-day grace period to contact that insurance company and see if you can keep that same policy at the same price. But then you might have to go through a medical exam, because with a group medical insurance policy through your job, it's all based off the group. You don't have to go through a medical exam. So when you were paying $8 every pay period, now it just went to $75 a month because you didn't meet the health requirement.
True. That makes a lot of sense. That makes a lot of sense, Tommy. Because
these are the secrets of the trade, my man.
But that's what I want you to explain, because I know a lot of times in our community, you know, when you talk about life insurance, oh yeah, I got a policy on my job, but you don't own that job, so you don't own that policy, and that policy isn't portable. It's not. That's not a portable policy. It's great while you're there, and you're banking on dying at that job. That's one thing, but if you're not there, that policy you paid into something that's not going to benefit you once you leave that job. Okay. So, with that being said, Tommy, your company, when you do an assessment, a financial diagnostic for somebody, what are the three things that you're saying? Hey, you know what, Mac? These are the three pillars that I got to have. I'm looking for in my clients, and that I want to accomplish with my clients.
Okay, it's very simple. It's goal setting. You and I have to come to an understanding of where you are today. There's no fantasy. There's no fluff. Where are you today financially? Secondly, where are you trying to get to in 6 months, 5 years, 10 years, 20 years? And then the third part is on me to come back to you and say, Matt, you say you are here. You want to be here. Here are the financial steps and vehicles we need to take to drive this road together. You and I are going to get in this financial car together, and we're going to get you there. Those are the three pillars of working with any financial advisor.
Wow. So the importance of goal setting versus dream setting. Because there's a difference. There's a difference between goal setting and dream setting. And Tommy, I think when people talk to financial advisors, individuals such as yourself, fiduciaries, I think you realize the difference between goal setting and dream setting. And I think that the pragmatic approach to accomplishing your goal, which ultimately will help you accomplish your dream, I think that's the benefit of having a financial advisor such as yourself. I want to kind of time oscillate over to powerofbrownmoney.com. That's your course. That's your website. That's got the ABCs of everything that you're doing. Kind of talk us about, what was the mindset? You tell us what made you want to say, you know what, I want to create something. I want to create a course. I want to break it down. Why should individuals come to Power of Brown Money, which I love that name, man, by the way.
Well, the story that I told you before about the Jewish kid coming to my office, I really left that meeting with that family realizing that there's a knowledge gap. There is, again, we don't have a problem making money. The challenge is, what do we do with it? And so if your parents didn't have that information as this kid did to pass that knowledge down to you, and their parents, and so on and so on and so forth, they didn't have that knowledge to pass down to you, I knew immediately that I had to do something. And I was like, it's within my power, because unlike a lot of financial advisors, I've had experience in all 15, I call them the 15 pillars of finance. There's 15 modules in my course in which I dub the 15 pillars of finance. I've had experience in all 15 of those pillars. So I can speak to what it takes and why you need to do what you need to do, but learning the fundamentals Learning who is your banking partner. Why is that important? You put your money, you direct deposit your money into a bank every pay period, and you don't even think about it. Mm. And you've been banking. I'll give you the scenario. You make $100,000 a year. You've been banking at this bank for 5 years. That's $500,000 you've deposited in this bank. In your savings account, you're getting 0.0003%. Now, is there any world that you think that a bank, at least one of the 5 major banks, are going to take your money and make 0.0003% return on that investment?
No. They wouldn't be in business. No, they wouldn't even be in business.
They wouldn't be in business. So to share in that and to give you a loan for a car, send your kids to school, to buy a house at a decent interest rate, that's a banking partner, right? You give them, they give you. Now, it's not going to be equal because they have to make money. I understand that. But you have to make money on your money too. I tell my clients this. Every dollar that comes into your household has to have a job. You have to give your money specific instructions on how you want it to behave. If your money does not have a job, every dollar, then your money is essentially unemployed. That's what the power of brown money is equipping you to do. Look at every dollar, every aspect of it. Credit, debt, budgeting, banking, saving, real estate, investing, insurance. Think about it. And that's why I tell my clients, if you have any scenario that has a dollar attached to it, I'm your first phone call. Because I have to make sure that every dollar that comes into your house has a job. Go ahead.
No, phenomenal. Because like you're saying, you're explaining to me that every dollar has to have a job, or essentially it's unemployed. Now, let's talk about the thing that we as a people in a community have always thought was, the utopian thing. Oh, I want to hurry up and own a home and have property and all these other things, and then real estate. But and we're buying homes, but are we understanding how to buy homes and use homes for an investment? Also, a lot of us haven't been privy to the knowledge and the importance of how to really play in the stocks. Does your program, Tommy, does your platform educate the unlettered in how to, one, understand how to use their real estate as an investment, to make sure it is an investment, and as well as understanding stocks? Because to the average person is like, well, what is this? Is this up, down, NASDAQ? I don't understand what that is. Do you take them through the fundamentals of that, the rudimentary knowledge of any of those things?
I have to, because you can't understand how to use a financial instrument if you don't know the fundamentals of it. People buy homes, and I can tell you, one of the things that from my practice, I talk to clients all the time. Well, my house is almost paid off. Okay, that's a great accomplishment. I'm so happy for you. That's amazing. But I have $150,000 worth of credit card debt that I'm paying 29%. Whew. Let's think about that for a minute. And that's a revolving credit card, revolving debt that you're paying the interest on top of the interest every month before you even touch the principal, unless you're paying 10x of that required payment every month. Right? So if you have $20,000, $30,000, $40,000, $50,000 worth of credit card debt, but the house is almost paid off, let's see, how can we transfer that debt to instead of a revolving payment plan, what about an installment payment plan where the interest is fixed for a certain amount of time and you pay that debt off? Because if you put $150,000 worth of credit card debt, it's going to take you forever to pay that off, unless you come into a cash windfall that you can knock it out in all one lump sum. Right? That doesn't happen to everybody every day, but it could happen. Or do you transfer that to it could happen, or do you transfer that into a loan that's backed by collateral, which you're getting a lower interest rate, plus it's fixed. Now you can pay toward the principal. Let's say it's 50,000. I'll give you a perfect example. Let's say it's 50,000 and your payment is $800 a month. Your house is paid off. You transfer that 50,000 to a 4.5% interest rate over 20, 30 years. That payment is $500 a month. But if you take the same $800 that you were paying revolving, put it over here, $400 goes to your payment, the other $400 goes to the principal. Now you just paid that debt off a lot sooner. The debt's not going anywhere. It's there. It's not going anywhere. You got it. Let's pay it effectively. That's giving every dollar a job. That's knowing what every dollar is doing.
Let me ask you this, Tommy. Credit card debt. If somebody says, well, Tommy, how do I use my credit card? I got all this. I got this great credit score. Yay, whoopee. And with this, I'm able to get all these credit cards. How do you advise people, Tommy, to use credit cards? When should you use a credit card? Should you use it for vacation?
You can use it for a vacation. Sure.
Okay.
Why not? You don't have to deplete your cash flow to live a good financial life. Yeah, credit cards are not bad. It's how you use them that makes them bad, right? If you're maxing out every credit card because you've got good credit, this bank want to give you 10,000, this want to give you 20,000. And here's where we make the mistake. When you go to college, who's the first person you see on campus? Oh, you're a freshman. Oh my God, man, come over here. And they can't do it anymore like they used to do it, but they still do it in their ways. Hey man, I'm gonna give you a credit card. $500 credit card, right? And you're thinking, oh my God, I got $500. I'm good. Come on, guys, let's go beer and pizza. Let's go. Next thing you know, you done max this thing out. Now it's $510 is the balance on a $500 limit credit card. And they say, Mac, all I want you to do is pay $10 a month, and you're good. 10 years later, you're still paying $10 a month.
Way more than $500. Good stuff. I think that's the thing, Tom. I don't want people to take from this where you're telling people, hey, you can't live a comfortable, enjoyable life. I don't want people to think you're anti-enjoyment, anti-fun. I don't want people to think that. But we're talking about having a balanced situation here where, hey, you know what? Have fun, but also let's figure out how we're going to sponsor that fun. And then when that fun is over, how are we going to be able to maintain this lifestyle so we can go have some more fun?
Exactly.
And I think that's important, Tommy, for us to understand. Let's talk about Roth IRA really briefly. And because this will be an ongoing series, man, and as we bring you back in the installments, we'll kind of talk more about one particular, financial component for that. But this is just an overview. This is just for the people to get their introduction to Tommy Stapleton. Let's talk about, just the Roth IRA. That's the thing. You're on social media and you hear all these financial gurus. Get your Roth IRA, get your Roth IRA, get your Roth IRA. I'm like, are you niggas getting paid to say this shit now? I'm just gonna keep it a buck. How many of you niggas are getting paid to say this? Because everybody now is that's the buzzword, Roth IRA. Who paying you niggas to say this shit? Roth IRA, Roth IRA. So Tommy, can you kind of break it down for the unlettered about Roth IRAs, man?
It's a financial vehicle, and it's a deferred financial vehicle. But the difference is, versus a traditional IRA, which is paid with pre-tax dollars, a Roth IRA is paid by post-tax dollars. So the money's already been taxed, and you're just putting it in that vehicle. So the biggest difference is this: in a 401k or an IRA, right? You can borrow against the money. You can take the money out at age 59 and a half. If you take it out before age 59 and a half, you get a penalty, a tax penalty, and a 10% penalty for taking the money out too soon. But the most important part in a traditional IRA or 401k, at age 73, the government's going to come knocking on your door. Hey, Mac, you had this money in this 401k or this IRA for 30 years. It's my turn. You've had it long enough. I need to get paid. They're called required minimum distribution, right? The biggest difference between the traditional IRA and a traditional 401k versus a Roth is you don't have those minimum required distributions because the money's already been taxed. The government's not knocking. You've already paid the tax. So there's nothing wrong with having a 401k and a traditional IRA, and a Roth 401k, or a traditional IRA versus a Roth IRA. Now, there are some technical rules on what you can put into both in any one given year, but there's nothing wrong with having those. I recommend them. I think that's the least that we should all have is a Roth IRA, to be honest with you.
Okay. So, Tommy, what is the best way? Because I know we're coming up on time, and I know you've been gracious with your time. You got other obligations to get to. What is the best way for someone to reach out to you, Tommy? Is there a minimum? Is there a financial plight someone has to be in before they can talk to a Tommy Stapleton? Or what is the best way to reach a Tommy Stapleton for advice?
The best way to reach me, let me answer the question first. There are no minimums. I need two things. I either got to have money or want to. I don't have to have both. I got to have one or the other. I got to have money or want to. Because if you don't have the money, I can get you there because you've got the desire to do better for yourself and your family financially. If you've got money, then that's a no-brainer. Let's work together. The easiest way to get in touch with me is call me at my phone number, 314-920-1010, or you can reach me on my email, tommy@collectivewealthpartners.com. That's tommy@collectivewealthpartners.com. I'd love to help anybody. Again, we don't have any minimums. We just need those two things to work with you. And our goal as a firm is to make sure that we're helping our community.
So it's fair to say, Tommy, this is obviously it's more than, for you, it's obviously more than, just something you do for a living. It's a passion. It's a purpose.
It is a passion. It is a purpose, for sure.
Yeah. So, guys, I think it's important. Anybody, and again, Tommy will be back. We'll be doing these installments at least once a month. We'll do another one, and we'll be talking about various different solutions and financial, components. So shoot me some email, DM me any questions you guys got. But for the most part, I think we covered a lot of ground just on the fundamentals of really just understanding the mindset of, like Tommy said, it's not that we veered off right, veered off wrong. We were never in the car. You can't veer off anywhere if you're not in the damn car. And I thought that the story of the young Jewish kid understand, saying, hey, for every one I spend, I gotta at least get two back before I can get another one. And that mindset of where at such a young age, and how we're just taught to be hyper consumptive, but we're not taught to invest and save and think long term. So, Tom, is there anything in closing that you want to share with the people, talking to people? Anything in closing you want to give, man, before we get up out of here?
Absolutely. Just one thing. Know what every dollar that comes into your household is doing. Account for every dollar. Because I can tell you this, because of the buying power of our community, everybody else is counting our dollars. We should count it too.
Man. Well, guys, there you have it. Hey, power of brown money. Let's go make sure you guys check this out. Let me type this into the chat real quick. You guys can go POW, see if I can type it in. Power. I'm typing this into the chat. I want everybody to go to the website. Go look at it. brownmoney.com. Type it in. Here you go, guys. And for those that are coming in on the replay and check it out, make sure you go to the power of brownmoney.com. It's on YouTube. This is streaming on YouTube and Twitter. I'm going to stream these reels shortly. I'll chop these up and make reels. But please go support. Now, we always talk about the importance of supporting each other. Here's an opportunity. Here's somebody that looks like you telling you how to make, what to do with your money. And don't go across the street thinking the ice is colder when it's not. I promise you it's not. The ice is not colder over there. He's got the same. Well, the ice is just as cold with Tommy as it is across the street. So please, I'm just saying. Sometimes you go right past Tommy And he'll tell you the same thing that the guy across the street tell you because you think his ice is colder than Tommy's. He's like, man, I just told you the same thing, my man. But anyway, hey, this is an opportunity to support somebody that looks like you, that actually cares about you and your dollar. So on that note, guys, I appreciate you rocking with us. Make sure you hit the like button, subscribe. Check out my man, Tommy Power Brown Money. He'll be back next month. We'll be doing more of these ongoing series as time goes on. We'll get deeper and wider based on your questions. And hey, man, everybody's going to get better in financial literacy. Tommy's who actually I'm working with him myself personally. So if I'm working with him, come on, man, you already know how I am, y'all. If I'm working with them, you got to be solid and thorough. All right, so until next time, say something slick and make it stick, baby. I'm Mac, and I'm out. Appreciate you, Tommy.
Thank you. Thank you, sir.
All right, my man.